Step 1. Business quality and economic moat. Company name and ticker, abrdn Global Income Fund. Inc. FCO. Business model: FCO is a closed-end fund focused on fixed income/global debt securities. Its goal is to generate high current income by investing in bonds, government, corporate, both investment grade and sub-investment grade, across developed and developing markets. Capital appreciation is a secondary objective, but only when aligned with the income goal. Is it easy to understand? Yes, the basic idea is simple. Collect interest from bonds, manage portfolio risk, and distribute income to shareholders. The closed-end fund structure means shares trade on an exchange, sometimes at a discount or premium to its net asset value, NAV, economic moat. In Buffett's world, moat implies durable competitive advantage. For a fund like this, moat is different from that of a business. Pros: manager experience and reputation. abrdn has global scale and brand in fixed income, can help get better access to bond deals, better terms, and diversified portfolio risk. Cons: many funds compete in the bond income space. Fixed income returns are more commodity-like. Interest rates, credit spreads, and macro risks dominate. The moat is thinner relative to a business with proprietary advantage. So, there's no wide moat in a traditional sense. Maybe a narrow moat from manager reputation and scale. But it is highly exposed to external risks, rates, defaults, currency, management. Managed by abrdn Standard Investments, a recognized name in asset management. It's a fund. There's less in the way of insider ownership or capital allocation in the Buffett sense. Management are. Fiduciaries' fees matter, but they don't run a product business. Transparency. Closed-end funds have periodic reporting, holdings are disclosed, fees are public. Overall, management is competent, but trust issues revolve around fee structure, risk-taking credit, duration, leverage, and consistency. Step 2. Financial health check. These metrics are harder to interpret for a fund than for a normal operating company. But here's the breakdown. Metric: current, recent value, Buffett, target, ideal. Comments: return on equity row, approximately 5.17% in one source, approximately 17.66% in another. Big discrepancy, greater than 15% if 17.66% is accurate, volatile or exceptional period. That's good. The 5.17% suggests more modest returns, needs consistency. Check. Debt to equity ratio DE approximately 0.44-0.5 pass if accurate, not overly leveraged. Fund leverage is still a risk. Free cash flow FCF, not directly meaningful for a fund. It distributes income rather than generating operating FCF. Consistent growing, hard to compute. Distributions are what matter. Net profit margin around 45% reported, though definitions differ for funds. Stable or expanding, likely good, but fees and expenses can erode. Earnings growth 5-year AFG, no stable figure available. Likely inconsistent due to macro factors. Consistent growth, probably inconsistent. Step 3. Valuation analysis. Valuation metric: current value compared to history. Industry comment: current stock price tilde. $5.12, $6.70 varies by source, class, and timing. Low absolute price, but irrelevant without NAV context. PE ratio, approximately 36.16, high compared to many fixed income peers. Likely reflects low earnings or high expenses. EB ratio, approximately 2.15, higher than many bond funds, suggests limited margin of safety unless justified by returns. Discount rate likely 6 to 10%, depending on yield expectations. Needs conservative approach in fixed income. Intrinsic value estimate difficult to pin down quickly. Margin of safety looks thin given high P, E and P, B. Valuation doesn't scream bargain. Step 4. Long-term outlook. Industry trends: fixed income, pressured by rate cycles and inflation. Global demand for income is strong. Risks: inflation, central bank tightening, defaults, currency swings, competitive position. One among many income funds, not unique, can maintain if risk is well managed, but macro conditions dominate. Reinvestment opportunities limited. Funds don't reinvest like operating companies. Growth comes from attracting more capital or shifting portfolio strategy. Step 5. Final Buffett-Style assessment metric. Buffett standard current value pass. Understandable business? Yes, yes. Strong economic moat? Yes, weak. None. Row greater than 15%? Greater than 15% mixed? Maybe yes. In best periods. Debt equity less than 0.5, 0.5, approximately 0.44. Consistent FCF? Yes, no. Not applicable. PE reasonable versus peers history high. Margin of safety price less than 4 thin per none. Trustworthy management? Yes, yes. Overall verdict: FCO works if you want income and can stomach risks from rates, credit defaults, and NAV volatility. It's not a Buffett-style compounding machine. No wide moat, no consistent growth engine. Valuation looks stretched. It's more of a tactical income play than a core long-term holding.